Stop what you're doing right now. The closing bell just rang. Friday, February 27th, 4:07 p.m. Eastern. And we just caught them red-handed executing the most blatant market manipulation I have ever documented. In the final 90 minutes of trading today, as silver was preparing for a massive weekend breakout above critical resistance, the CME experienced what they're calling a technical glitch. The public trading feeds that retail investors use to watch prices and execute orders were completely frozen for 45 minutes. Your screen showed nothing. No price updates, no trade executions, system offline. But my institutional data feed, the one that costs $40,000 per month and runs on separate infrastructure, never went down. And what I saw during that 45-minute blackout will be remembered as the moment they exposed the entire fraud. Over 42,000 naked short contracts were quietly traded in the dark pools while retail was locked out, artificially smashing the price down below the resistance level that would have triggered a massive short squeeze. They literally unplugged the monitors to save the shorts. This is John A.G., and what I'm about to show you is not a technical failure. It's a coordinated takedown that just backfired so catastrophically that the Eastern markets are now actively trapping the Western shorts in a vice they cannot escape. Let me show you exactly what happened minute by minute because the precision of the timing proves this was planned. 2:31 p.m. Eastern, silver spot price hits $91.80. That is 1.30 below the critical resistance at 93.10 that has capped rallies for the last 6 trading sessions. Technical traders know that a break above 93.10 triggers stop-loss covering from shorts and algorithmic momentum buying from trend followers. At 2:31 p.m., silver is building energy for that break. Volume is increasing. Bid pressure is building. And then, at exactly 2:34 p.m., the CME public data feeds go offline. Retail trading platforms show connection lost or data unavailable. The charts freeze, no price updates. My contact at a major retail brokerage confirmed at 3:52 p.m. that their entire client base was locked out of live silver quotes from 2:34 p.m. to 3:19 p.m., 45 minutes. But institutional desks, the ones with direct market access and premium data feeds, saw everything. And what they saw was 42,000 contracts, representing 210 million ounces of notional silver, sold in coordinated waves while retail was blind. By the time the public feeds came back online at 3:19 p.m., silver had been driven from $91.80 to $84.60, a 720 crash. And the breakout that was building never happened. System collapses don't happen randomly, and neither do 45-minute data outages during critical price action. The CME will claim this was a technical issue, a server problem, an unfortunate coincidence, but the institutional traders who had functioning feeds saw the sell orders. My source at a commodities trading desk sent me execution data at 3:47 p.m. showing the wave pattern. First wave, 2:38 p.m., 11,000 contracts. Second wave, 2:49 p.m., 14,000 contracts. Third wave, 3:03 p.m., 12,000 contracts. Fourth wave, 3:14 p.m., 5,000 contracts. Each wave timed to maximize downward pressure while retail was locked out and unable to buy the dip or provide bid support. This is not how technical glitches work. Technical glitches are random. They don't occur in coordinated waves. They don't execute 42,000 contracts in 45 minutes while the public is offline. This is a controlled demolition of a price breakout using a manufactured blackout to hide the manipulation from retail investors who would have otherwise seen the massive sell orders and known the price was being artificially suppressed. Here's the real-time intelligence that shows how the Shanghai price floor turned this manipulation into a trap. At 3:07 a.m. Saturday, Shanghai time, which is 2:07 p.m. Friday Eastern, the Shanghai Gold Exchange issued a formal market notice setting a physical silver price floor at $88.50 for all settlement transactions. This is unprecedented. Exchanges don't normally set price floors. They let markets trade freely. But Shanghai saw what was happening at the CME. They saw the blackout. They saw the price being smashed, and they made a strategic decision, set a hard floor at $88.50, which is above the CME crash price of $84.60, and commit to buying every ounce of physical silver offered below that floor. My source in the Shanghai physical market confirmed at 3:34 p.m. Eastern that within 90 minutes of the price floor announcement, Asian sovereign wealth funds and state-backed trading entities executed buy orders totaling approximately $2.1 billion in physical silver. Not paper contracts. Physical metal with guaranteed delivery. They are using the CME manipulation as an opportunity to drain Western vaults at artificially suppressed prices while guaranteeing themselves a floor price that ensures they cannot lose money even if the manipulation continues. Let me explain why the retail inventory spoofing is the proof that the physical drain is critical. My source, inside a major North American bullion logistics company, sent me an encrypted message at 3:41 p.m. Friday. The message confirmed that two of the top 3 U.S. bullion distributors received directives from their primary suppliers late Thursday night to list all 100-ounce silver bars as out of stock or temporarily unavailable, effective Friday morning regardless of actual inventory levels. The directive, according to my source, came from the refiners and wholesale suppliers, who are facing unprecedented demand from Asian buyers and need to prevent retail orders from depleting the limited inventory that exists. One major distributor, according to internal communications my source accessed, currently has approximately 14,100-ounce bars in inventory. Their website shows 0 available. The inventory is being held for institutional clients and large volume buyers, while retail is told there's no stock. This is inventory spoofing, lying to customers about availability to ration supply during a shortage. And the fact that it's happening coordinated across multiple distributors simultaneously means the shortage is real, and the entities controlling inventory know that if they sell to retail at current prices, they won't be able to restock. Here's the emergency money trail that shows who was buying while the CME was frozen. Between 2:34 p.m. and 3:19 p.m., the 45-minute blackout window, my contact at a Swiss refiner confirmed they received orders totaling $580 million for immediate physical delivery. The buyers were not retail investors who were locked out of the CME feeds. The buyers were institutional accounts that saw the manipulation happening in real time on their premium data feeds and used the artificial price drop to secure guaranteed delivery at $85.87 per ounce. One order alone, according to my source, was $220 million from an Asian sovereign wealth entity with delivery to a Singapore vault over 120 days. That buyer is locking in $85 silver today, while Shanghai has set a floor at $88.50. They're guaranteed a minimum 4% profit in 120 days if Shanghai holds the floor, and potentially 30-50% profit if the CME manipulation fails and spot price recovers to 110 to 130 physical levels. The entities with access to functioning data feeds during the blackout are buying. The retail investors who are locked out are selling or sitting confused. This is wealth transfer through information asymmetry, and it's illegal. Now, let me show you why the 88.50 Shanghai floor creates a mathematical trap for the CME shorts. If CME paper silver is trading at 84.60 and Shanghai physical has a guaranteed floor at 88.50, there's a 390 arbitrage spread that is risk-free for anyone who can access both markets. Buy CME paper at $84.60, take delivery, sell physical to Shanghai buyers at 88 or 50, pocket $390 per ounce. On a 10 million ounce position, that's $39 million guaranteed profit. The only limitation is whether you can actually take delivery from CME. And that's the trap. The entities trying to execute this arbitrage are submitting delivery requests to CME. CME either has to fulfill those deliveries, which drains registered inventory that's already at 39 million ounces, or refuse deliveries and admit they cannot provide the metal. If they fulfill, inventory crashes, and the next wave of arbitrage traders submits more delivery requests. If they refuse, they've defaulted, and the paper price becomes meaningless. Shanghai's floor price forces CME into an impossible choice: deliver and die slowly, or refuse and die immediately. Here's what the coordinated timing of the glitch, the Shanghai floor, and the inventory spoofing tells us about the next 72 hours. The CME manipulation happened Friday afternoon. Markets closed for the weekend. The Shanghai floor was set Friday evening Asia time. The inventory spoofing directive went out Thursday night for Friday implementation. All 3 events coordinated around the Friday close and weekend gap. The entities orchestrating this know that weekend gaps are where the most damage occurs. Retail cannot trade. Institutional players and foreign exchanges can. If Shanghai buyers drain physical inventory over the weekend at prices below their $88.50 floor, while CME is closed and cannot respond, the gap up Monday morning could be catastrophic for shorts. They are trapped at 84.60 paper prices, while physical is being bought at 88, and Shanghai is guaranteeing 88.50 minimum. When markets reopen Monday and physical premiums are $15-25 over CME paper, the divergence becomes undeniable. Let me show you the 3 scenarios for Monday's open based on what happens this weekend. Scenario 1. Shanghai buyers successfully drain significant physical inventory over the weekend. Monday morning, dealers wake up to empty vaults and cannot fulfill orders. Physical premiums explode to $20 to $30 over CME spot. The paper physical spread becomes the story. Mainstream media finally covers it. Confidence in CME collapses. Paper trades at discounts to physical permanently. Scenario 2. CME announces emergency measures over the weekend. Margin increases, position limits, or trading restrictions designed to prevent the Monday gap. The announcement confirms the manipulation was intentional and the system is broken. Shorts get temporary relief, but the credibility damage is permanent. Scenario 3, nothing happens over the weekend. Markets open Monday with silver at 84.85 paper. Shanghai floor holds at 88.50 physical. The spread persists. Arbitrage traders flood CME with delivery requests. By Wednesday, registered inventory is below 20 million ounces, and first notice day for April contracts is 2 weeks away. The system breaks mid-month instead of month-end. Here's the asymmetric position that protects against all three scenarios. Physical silver held outside North American distributor networks, outside CME warehouse systems, in allocated storage or direct possession, where inventory spoofing cannot affect your holdings. The entities that bought $580 million in physical during the blackout are not holding it in vaults that can be subjected to spoofing directives or force majeure clauses. They're moving it to Singapore, Hong Kong, Switzerland, jurisdictions where North American retail inventory controls have no effect. When Monday comes and retail investors in the U.S. try to buy physical, they'll find out-of-stock messages. But the entities positioned in offshore allocated storage before this weekend already have the metal. The inventory spoofing doesn't affect them. The CME glitch doesn't affect them. The Shanghai floor protects them. They're positioned for every scenario. The second asymmetric position is understanding that the 42,000 contracts sold during the blackout represent approximately 210 million ounces, but CME registered inventory is only 39 million ounces.